Today, we're diving into the acquisition process of multifamily investing, what to look for, what to avoid in 2023. So, I'm bringing in Derek Czarkowski, who oversees that entire process of acquisitions at Russell Reeves. Every day, he's analyzing the deals. So, before we get into the nitty gritty, you've seen all sides of multifamily working through the housing crash of 2008 to now. So, as we navigate this current climate, what are the top three things that you look at in a multifamily deal right now?
I look at new supply, that's for sure. So we're kind of consistently looking in areas with limited new supply or high barriers to entry. We're looking at markets that are fundamentally strong. They have a diversified economy, large percentage of government contractors, which will always be pretty active, even in the event of a correction of any sort. And then additionally, we look for organic rent growth that's not been completely saturated over the last years. It's not commodity. It's not like the trendy location of the moment. It's just slow and steady, sustained growth with high barriers to entry as far as new construction.
When you look at San Diego, because Russell Reeves obviously has found a niche in the San Diego market, how do you view that market right now compared to like the hot markets? Like I live in one of those hot markets, Salt Lake City, a lot of development, Phoenix, a lot of development.
Yeah, so Austin, Phoenix, Salt Lake, they saw a ton of construction here since COVID, and before that, there was already a pretty big pipeline. So, because of all that new construction, you've got a ton of Class A product that's coming to the supply, and the absorption hasn't been able to keep up with it. On top of that, the kind of demographic trends from people moving and relocating due to COVID and working remote to more affordable markets like Phoenix, Austin, Salt Lake, or previously affordable markets. They're not so affordable anymore.
Yeah.
From places like California, well, that change in rent that has made those the hottest markets in the country, the double-digit 20% plus rental growth, where you're seeing lease trade outs at like 25% over their previous rent. That kind of created an inorganic spike, and because of that, rents are correcting back down to the normal trend line. In markets like San Diego, where it was already quite expensive, relatively speaking, to other parts of the country, you didn't see that spike. You actually saw a lot of people moving out of those markets into these more affordable markets. Like the Bay Area really struggled because so many of the employees were remote workers. So in San Diego, because of the diversified employment base, because of the limited product and pipeline for new product, you have a lot of these barriers to entry to develop in California in general. It creates kind of this, I guess, more of a smooth, steady growth curve. And we like that because it just won't fluctuate as much during market changes. So in the really good times, we might not benefit as much like Salt Lake and Phoenix, but then when kind of it corrects, we're not seeing that bounce back to the normal trend line like these other markets are experiencing right now.
And I guess the elephant in the room is the increase in interest rates. How do you see that affecting these kind of deals and the performance hitting that IRR?
Yeah, so that's been tough for the entire industry. That's probably the limiting factor for everyone. That's why there's fewer deals being done, because uh, finding capital and debt that is appropriate for achieving your returns is becoming more and more challenging. There's less liquidity in the market. There's less debt available. There's fewer lenders that are willing to kind of overcome the risk inherent in a higher interest rate. So and kind of achieve the rents or growth needed while organic rental growth is trending to like 0 to 5%. So finding that debt is really challenging for everyone that's a buyer. And then on top of that, a lot of people put new debt on their assets in the last 2 to 3 years since debt was so cheap. So a lot of sellers aren't motivated necessarily to sell right now. So because of that, it is challenging to find a debt product that fits our model. Fortunately, we've been using kind of construction bridge loans from the beginning 24 months ago when we first started doing these projects, because we are building ADUs within our properties. So we're taking debt that was always kind of higher cost, higher interest rate, and it hasn't changed in cost as much as kind of conventional debt. So, even though we're using debt that's a little bit more expensive, we haven't been impacted by the change in the cost of the debt as much as other people. It might have gone up for us like 25%, whereas for everyone else it's gone up 100%,
Mm.
the cost of their debt. So we're a little bit insulated from that. Not it's dampened the effect of the changing interest rates.